Hey everybody, Marty Missouri here. It's the 15th of February, 2026, with, we'll call it an economic and market update for you today. Want to start with some data. Just scored our PWA index, which is more or less a barometer for us for general conditions, and here's our very simple graph. The zero line separates conditions where odds lean recessionary versus expansionary, and as you can see, we had risen slightly into where odds would favor expansion right near the beginning of the year, first time in about a year, and then came right back down into slightly negative territory, kind of tested the zero line, let's say, and now we are at the highest level we've been in quite some time, at least 3 years or so. So that spells, on balance, optimism for the economy. I would say the picture is mixed. I'm going to show you some data points here in a second. And then we're going to get into 2 or 3 of the market-based indicators in this index. There's 43 data points in total, by the way. Right now, since I'm mentioning it, and among the positives, by the way, consumer spending, personal income, the Institute for Supply Management, Manufacturing, and Services surveys, industrial production, durable goods orders, capital investment, commercial and industrial loans. I'm going to show you that chart today. Heavy truck sales, Caterpillar global sales, global purchasing managers indices, the U.S. Economic Surprise Index, which I'm going to feature here as well. Commodities are painting a relatively bullish picture about the economy. That's been volatile of late. And then negatively, auto sales, housing starts, housing permits, consumer confidence, home builder confidence, job openings, labor market conditions, Cass freight index, the freight data, the ratio between leading and coincident economic indicators, the Chicago Fed's own national activity index, and then a couple of market-based indicators that I'm going to show you here today. Let's get into the charts here. So the first one up is retail sales, which have been declining now for the last couple of months, 2.43% year over year, negative month over month, 0.02%, call it flat. Core retail sales month on month, that X's out food and energy, you can see are down 0.1%. In our index, we continue to give retail sales a neutral score. There's also the Red Book weekly that we track that's been looking okay. The non-farm payrolls came out Wednesday. They were delayed. Normally they come out the first Friday of the month. We could get somewhat into the weeds on this one. It's going to be interesting to see. I think there's going to be some notable revisions in February for January, so I don't want to spend a lot of time on it. We did see 130 total payrolls, with 65,000 was anticipated. Now, the lion's share of those increases had to do with healthcare and social services employment. So, but there was a little uptick in manufacturing. There was a little uptick in construction. So those would be on net bullish for the economy. But there's, I don't know, a lot that can get in the way. We could start talking about immigration or lack thereof, or the exodus of immigrant workers in that space. Hard to count. And then new jobs in that space could be, U.S. citizens getting jobs there. Could have to do with AI data center construction and the big push that continues to go on there and so on. There were weather factors that didn't seem to impact January like maybe we thought they would. So we'll see. Every month gets revised. The unemployment rate dropped a tick to 4.3. Average hourly earnings improved slightly. The quits rate stayed right at 2.0. The job openings did roll over pretty hard here last month. Labor force participation ticked up a little bit. The U6, which includes discouraged workers, part-time workers, went down. That's unemployment. The U6 unemployment rate went down from 8.4 to 8%. And the household survey, which was really sketchy for January, they didn't get good participation, showed 528,000 jobs. But we could get a big revision there as well. In fact, some of the data was actually missing that they normally compile there, that they'll have to revise January for February with. Definitely an improvement on net. So for our purposes, Even though, again, the composition was funky, the timing, weather, some things missing, that sort of thing was funky, we still had to go from a negative reading to a neutral reading on employment. Small Business Optimism Index for January came out this last week. We had optimism tick down just a little bit. Overall optimism, 99.4. Hiring plans ticked down as well, and capital expenditure plans kicked down as well. So not a super rosy picture, although the level up here of overall optimism isn't low historically. It's just the other factors, and then the direction is just something to pay attention to, of course. The commercial and industrial loans saw a big jump that took us from neutral to positive. These would be the kinds of loans that would feed expansion, so that would be considered bullish, right, for the overall economy. The Consumer Price Index came out on Friday, went in the right direction. You can see headline CPI went down to 2.4 on a year-over-year basis, 0.2% month-on-month. However, when you X out food and energy, it did go up a tick to 0.3% month-on-month. But the core year-over-year base effects do fall into that, where it was a year ago versus now, down to 2.5. So overall, inflation via the CPI read was positive, meaning going in the right direction on balance in January. The Employment Cost Index, this just comes out quarterly. So for the fourth quarter of last year, that came out, and you can see that took a dip lower on the quarter. That was viewed as a positive, so that took that one from negative to neutral in our index. As you can see, the relative level is still, historically high, but the direction is going in the right direction if you think about employment costs as they relate to inflation. And then break even, so this would be a market-based indicator of inflation risk in the system. So these are CPI swap rates, 2, 5, and 10 year, and you can see they all took a dramatic drop here with the latest data. And again, I would view that as a positive. It's a negative when you have a real weak economy, obviously. It could be a sign of a weakening economy, but right now we'll view it as a positive. The economy seems to be holding up okay with inflation coming down a bit as we speak. Now, longer term, and I've spent a lot of time on this last 2, 3, 4, 5 years, I did on the last video, we are structurally bullish on inflation, meaning we think that it will be, on average, notably higher over the coming decade, let's say, than it was over the last few decades, frankly. Okay, so one of the market-based indicators is the stock-to-bond ratio. So this goes up when stocks are outperforming bonds, which tends to signal robustness or be essentially a positive indicator about economic conditions when the price of stocks is going up relative to bonds. And you can see through the first month of the year, that was the case by 2.6%. But as you can see here of late, it's completely flipped. Bonds, using our TLT, which is the 20-year plus Treasury Index ETF, has been outperforming stocks now by 3%. Now, I think to qualify this, and you'll see that here in a minute, this is referenced against the S&P or using the S&P 500. The S&P 500 is heavily weighted to tech. Tech's having somewhat of a rough go of it so far this year. The S&P 500 equal weight index, if we ran that ratio, would be positive, meaning it's outperformed bonds by probably a couple of percentage points. Now, the equal weight is still the S&P 500, but it's not capitalization weighted, meaning the bigger companies don't get more influence on the index than the smaller companies. Every company, let's say there's 500, a little more than 500 in there, but if there's 500 companies, each one has 1/500th influence on the move in the index. The consumer staples to consumer discretionary ratio, another potential indicator about the economy. Legendary investors like Stanley Druckenmiller talks about this a lot. And so consumer staples, again, versus consumer discretionary. When it's going up, consumer staple stocks are outperforming consumer discretionary, and vice versa when it's going down. Staples being the companies, the stocks of companies that make stuff you buy if you want to keep living, right? Things you have to have. Discretionary represents the stocks of companies that you spend money on when you have extra money to splurge, automobile stocks, restaurant stocks. Amazon has had a real rough go of it of late, which has impacted that index as well. So there's some idiosyncratic, company-specific risk in these things as well that we need to be aware of. But 18.4% outperformance is really massive and doesn't say great things right here about the overall state of the economy. So there's one indicator that's not, necessarily consistent with our relatively sanguine view that we have as a firm right now about the economy. Okay, so the charts, the price charts. So here's your S&P 500 regular cap-weighted index, right? And notice, as I keep pointing out, that we are literally nowhere in the last, going on 3 months. So late October right here to now, we're actually less than that. So you could actually say we are all the way back here to early October levels in the S&P 500. And then you can see this kind of this range that we have in here. Now the green line is the 50-day moving average, which is a very important indicator among technicians. This is a simple moving average. And as you can see, we broke down there big on Thursday, tried to come back and lost it right at the 50-day moving average, which became on Friday technical resistance. So you can see it serves both purposes. Here it became support, and you can see that it pretty much tested it here, but then survived this test. It's been good support. It's testing it again. We'll see how it shakes out. If you break down with force, then you're going to run into very quickly. This could be a pretty solid support zone here, along with a 200-day moving average. So if we did see about a 5% hit here, we would probably see a pretty good bounce, all things equal, off of this level right in here. But clearly the S&P 500 is kind of been stagnant in here. It will break out in one direction or the other. Of course, the question that we don't know the answer to is which direction. Our momentum indicators would suggest that odds favor a break further below. But we'll see. Time will tell. And then the NASDAQ 100 index, or in this case QQQ, which is the ETF that tracks it, you can see that it lost its 50-day moving average. Then it provided pretty stiff resistance along with the 20-day moving average, which rolled over below the 50. And at 20, as I've shown you in the past, has been a pretty important technical indicator for this particular ETF or index. And so now we are pushing these lower levels here, taking us back to September of last year, closed right above that support line right there. We'll see if that doesn't become resistance over the next week or so. The momentum indicators are still pointing to some notable downside risk, I would say, in the near term anyway. And then here's that S&P equal weight. Again, same 500 stocks, but you can see that it has done very well since last October. So it was sitting here at 192 or so last October, right? About when the S&P peaked, and it's below that. Well, the S&P equal weight sits here at 202. So that's a very nice move. As you can see, though, momentum is finally topping off. Now you got nothing but pretty much confirmation as things went up by momentum. Here you had momentum waning, you had it correct, and then from there momentum continued to rise till about right here. Now momentum is rolling over, which suggests that even in that equal weight space, just technically speaking, there is some potential, for some downward action, maybe breaking through this pretty defined trend line right here. We're pretty neutral on the market. I wouldn't say we're bearish in the short run. I think here relatively soon we're going to start seeing some pretty significant tax refunds come to U.S. consumers. We'll see what they do with that money, if that brings flow into markets, equity markets, what they can do with cryptocurrencies and that sort of thing. We'll see. But sentiment among consumers is not great. So this could be one of those scenarios where they take that and maybe pay down debt as opposed to take risk with it. If they go out and spend it, though, and go to dinner and use it as a down payment on a car, it's going to show up in the coming months economic data, which would be, positive on balance, at least in the near term. The dollar, the all-important dollar. Remember, I tried to paint this bear flag pattern. It's not kind of your classic flag. That flag itself is a little big for my taste. But we did roll down off of that, and then we're catching support right here at this 96 or so, and just kind of meandering over the course of last week. As for gold, you can see again we had that 17% dip that we were calling for, at least that. It promptly shot right back up, sitting above, and this is the ETF that tracks gold, sitting above 450, and just kind of living on that line right here. The dollar falling right here certainly didn't hurt gold, and you can notice how gold is kind of consolidating as the dollar consolidates right here as well. Good old silver, which has been crazy of late. This is that 30%-ish decline. Let's look at that again. Biggest one-day decline ever, 37%. Came back, retraced that right here, and then has lost it right there at the retracement where support is found, as I told you here, was a falling 50% back from this move from the low of last year. Again, kind of consolidating a bit here with the dollar as well. Rough couple of days to end the week this last week. Would not surprise me to see the down leg resume here going forward, particularly if the dollar gains some strength. But I'm not making a call. We have cut that position down. Notably, it was obviously wonderful as we rode it up here as well. Gold, we cut back a bit as well, but we're hedging gold right now. We do have pretty strong conviction longer term on gold. Short term, maybe not so much. And then last, I just wanted to show you this VIX chart. It's been a long time since we've looked at this, but I've done this analysis for you in the past. So here's the volatility index, which measures implied volatility in S&P 500 options contracts. And this is a 5-year chart. And what I'm showing you here, and this is actually tracking the VIX curve all the way out to 8 months, but the big thick green line is the spot VIX. And what I'm showing you here is that when the VIX began to trend higher, that's people pricing in risk and say expectations of higher volatility in the S&P 500. And doesn't always spell doom. Here back in 2021, you can see we had a higher low, and inspired me to draw a line there. And then we had about a 6% correction there. Here it was bigger leading into the bear market in 2022. And then when it stays above 20 and finds support at 20, that becomes kind of a dangerous zone. At least it has in the last 5 years. So here you saw me drawing these circles right when it would test 20, and sure enough, it would find support there. People would start buying put options or pricing in higher volatility, and then the market would fall finally to settle in at about a 28% decline in 2022. And then we kind of rallied nicely out of that. And then suddenly the 20 area became resistance, and that would be perhaps a level where somebody who's trading this would be buying on those pops to 20, expecting the VIX to roll back over. And you can see that was great until we started to show higher lows again, 11% decline, again, 6% decline, 10% decline, 21% decline. And again, those declines tend to happen more, the bigger declines, when we're spending more time up here above 20. Again, for what it's worth, I wouldn't put overemphasis on things, but I do think that after a while, these are important to look at. And just the fact that the market is pricing in higher volatility tells you something about sentiment. And if the market, using air quotes in this case, is correct, well, then we could see some more pain. And here you see again 6%, and now we're seeing quite the spike in the VIX. So, that says that short-term traders should potentially be on their toes. But again, maybe we find support right here at 20, roll over, and then we're off to the races to the upside again. In terms of staying on your toes, again, we are investing our clients' long-term money, so we aren't necessarily always looking for short-term trades, but we are being very, very tactical. Our last move was back on January 26th when we cut exposure kind of in the metals commodity space because they were just running up too high, too fast. Timing looked to be pretty good there. It wasn't dramatic. We still have the positions that we have strong long-term conviction in. Looking very closely, to be honest with you, at the software sector right now. It's down almost 25% this year, largely on the notion that AI is just going to do a massive number on the software industry. Been spending time this weekend. We'll spend a bit more on that narrative. I, for one, am not convinced that this is the end of the world for software stocks. And so we may very well be, and I suspect we will, take advantage and at the margin add some exposure to this super beaten up area here of late, that in a economic setup where we don't see massive recession, and maybe if these inflation numbers are right, we don't see a massive move in inflation or a critical move in inflation and interest rates this year, this could be a very good entry point for software stocks. We'll see. Right now, we like our portfolio. We definitely are short the dollar, meaning we will do better as the dollar is weaker, and we think that's a long-term trend. But along the way, there are going to be periods where I do think the dollar will see its rallies, and it may have a net negative impact on our allocation. We do have things that do well when the dollar goes up as well. But there's always going to be, kind of an underlying bent based on how we see the world. And that's been working out wonderfully, clients, as you noticed last year, and even so far this year, certainly relative to what's going on in the stock market. But we're not taking anything for granted. And as I just mentioned, we are looking for pockets of value where we can find them. And we are not shy about taking some things off the table when we think they've gotten too far out over their skis. Thank you, as always, for watching and listening. Hope you have a great rest of the weekend, and talk to you later next week. Bye-bye.